All right, good evening and welcome to tonight's webinar. My name is Mike Rotting. We'll be discussing a little bit the market influences of Q1 for 2021. Obviously, a lot has changed since we've all went through 2020. It has a ripple effect, and there's a lot of things that changed since then, obviously. Before we get into everything, obviously, we do have to take a look at the risk disclaimer, obviously standard. Give you a minute to read through it. I think it's good enough. All right, so what we're going to discuss, well, I'll briefly introduce myself for those that haven't joined us previously, so you know what I am and who I am, and etc. Then we'll take a look at the global outlook first. So a little bit more on basically what are the hedge funds looking at the moment, what are the strategies from JP Morgan, what are these guys currently thinking? I mean, I get their reports, so I have a good idea. Then we're going to look into commodities and FX, which is what most of you are retail trading in. So I'm going to go through a few pointers on each one of them. Not the whole list, obviously, just a few majors like gold, oil, stuff like that. And then I'm going to explain a little bit how I would use that in my trading, right? Using all this information, how to use that in my trading. And then the last part is obviously going to be the Q&A, where you guys can fire away. So first of all, about me, well, like I said, my name is Mike Rotting. Nice to meet you all. I've been retail trading for a little over 15 years. I started in college, when I was studying international business studies. Yeah, and I kind of tried out trading. Obviously, like everybody else, I went through the same hoops, screwing up one account, then another account, thinking this was the golden egg and then that the golden egg. Eventually, I figured out what did work for me. Grew that to a point where I could stop trading FX for the main income and do multi-asset funds and stuff like that. Which brings me to what I do. After my trading got noticed, I started working for some brokers, some retail traders brokers. Then I started doing some coaching, and I now am studying for international financial advisor. To try and help people how to connect their wealth, and obviously those that want to trade FX, I can assist with that. And then I also do the webinars, and this is in the hope to pass on as much knowledge that I've accumulated in my time to the best of my abilities to you. So hopefully somebody can benefit from that and go down the same road. So yeah, global outlook. Well, obviously a lot changed. Obviously the USA is the biggest one. We'll discuss COVID and we'll discuss Brexit. So why the USA first? Well, obviously new president. Biden in, Trump's out. So we took the Cheeto out and we put some geriatric old guy in. What does that mean for us? Well, for the US, it's actually a good thing that Biden's in. It's a more stable, more reliable, and predictable type of politician in the sense that he's the same as always. So there's nothing that he's going to do that's going to oh my God, shock anybody, which is a good thing for a lot of stability factors. However, I think that the problem we're going to see is that he's also a much more old-fashioned type of president. Obviously, his age does factor into that. He's very much more like God above everything, and military good, stock market not good. We already see that he's not so much of the commercial-minded kind of guy. And that is obviously what Trump was, right? So for the stock market, the US stock market, Trump was a really good president because he only had his own interest at heart in most of the cases, with his own companies. And, they say that they have to be impartial, but let's be honest, we all know how people think. So, everything was based upon that commercial and that capitalistic mindset. With the new president, we're going to have to see how this works, how this is going to work out. Obviously, we see that the US stock markets have been doing fine. Like they've got that momentum going. Biden's proactive approach to the pandemic and trying to actually get something done there has boosted a little bit of confidence in the US. But the main reason, obviously, the stock market in the US is still, as strong as it is, it's going to have to do, obviously, with Silicon Valley. I mean, everything still runs from there. As long as the pandemic is there, that market will keep growing because there's basically nothing else to go to. And we saw a little bit of a side effect on that, like even with the NFP being historically bad. For instance, when the NFP turned out, a minus instead of a predicted small gain, right? 30,000 was minus 70. The market didn't really react to that. It was already factored in to be bad anyway, so it didn't really matter that much. Now, this is going to have a ripple effect. We're going to have to see how the effects of the stock market are going to go through. I think for Q1, there's not going to be that much change because it's too early and there's too much of after effects from 2020 still in the market. It will probably start to slim down a little bit. I expect that by the end of Q1. But with a Q&A, we can go into specifics. One part I didn't want to touch on was the whole fiasco with GameStop. The GME stock, like the whole Reddit thing. The second that happened, I warned people to not jump on it because that's a bubble waiting to happen. It's not the first time this has happened, except this is the first time it was this publicly. And it always ends in a crash and burn. And it's got a very simple reason for that. And this is something I wanted to touch on. Are we going to see more of this kind of thing? Maybe. It depends. And it is going to depend on the regulatory body. It is a very slippery slope that they're on. So from one side, you have to take away the factor of you cannot forbid people to trade on the market. This is everybody's freedom, and you want people to make money. Money needs to go into the market to make the market move. It be the stock market, it be FX, it be indices, it doesn't matter. The problem is when you inflate things that are beyond where they should be. The global economy is a big machine that is actually a lot more fragile than people think. When you do little spurs like this, it can cause a domino effect. It's kind of what happened in 2008 with the housing market, right? You keep pushing and pushing and pushing and pushing. Eventually, it will break. And that causes a ripple. Now, in this case, obviously nothing serious happened apart from a few hedge funds that went bankrupt, and they weren't the biggest ones. The biggest ones could always short against it and hedge themselves. But one of these days, if they do this again, it's going to cause the wrong domino stone to fall, and when that happens, the wrong trust funds fall that, and then you get a ripple effect, because that means that certain incomes are going to fall away, which means unemployment is going to rise, which means that then those people can't pay rent, which means evictions, which means, so you get like this whole chain reaction out of this. And it can start with something stupid as this. So what I think is going to happen is that the authorities are going to step in. I do think there's going to be a cap that the next time something like this happens, there's going to be a hard cap that they just tell the brokers they're not allowed to sell the stock anymore. Literally just make a ceiling to protect it. And the way that I explain it, even though this is a very slippery slope, the way I explain it is, okay, retail traders should have the freedom. But if you look at it this way, let's say it's, and don't understand this in a demeaning way because I'm part of the retail traders, just like you guys, right? Let's say we're kids on a playground. And now we've given all these kids sharp knives because they can play the game for real. We know that they understand it sharp and they need to be careful. However, we also know for a fact this is eventually going to go wrong somewhere. So it's better to take the big swords away from them and give them, fighting sticks. That way they can still pretend to play the same game, except if it goes wrong, you might, crack a window or knock somebody in the head, but it's not going to be immediately, a bloodbath all over the place. So this is a very, very analytical way of saying it, but this is the concept, right? It's still allowing, but in like lesser form. It's like a buffered version, and that is kind of what FX is in essence anyway, right? provides us the opportunity to trade on a market that is normally not within our reach because we simply don't have the funds for it. Right? So that's the concept. And I think that's going to happen now in the stock market as well. I think this is going to get buffered by this. How is that going to affect the stock markets? I think there's going to be certain specific stocks that are like low-key, long-lasting ones that would be targeted, like GME, that, once it gets the word out that the brokers are going to cut them and just make sure that there's no random, spike of purchases on those. I think that covers the US. Obviously, the stimulus package, we'll have to see how that packs out. I think the stimulus packages are necessary, but at the same time, I think it's going to have long-lasting consequences on the market. And, most likely it will have a backlash down the road because you can't keep spending money from tax without the economy turning, without new money coming in. You're going to run out way too fast. And this is going to have consequences down the line of, stricter. We're going to have another round of, recession where, budget cuts here and there. And knowing the US, it's not going to be defense budget cuts. It's going to be budget cuts in more healthcare, more budget cuts in, schooling, and all the areas where they basically already have need of help. They're going to get cut even more probably. So COVID, well, I think everybody's tired of hearing COVID at this point, coronavirus. But so the vaccination rounds came in, and obviously we're in the middle of basically a vaccine nightmare where AstraZeneca is being pushed around and shunted. And now you have Pfizer, and then you have the Russian one, and then we have the Chinese. It's like, it's all over the place, and nobody wants to work together. In the end of the day, okay, they are pharmaceutical companies. There is money to be made here. So it's an opportunity of a lifetime, obviously, for them. But that comes with a silver lining. I do think, but by now, and I know for a fact from the reports I've gotten that by now the fund managers, the hedge funds are factoring the negativity of COVID, and they're starting to price it in. But that is with a side look. For instance, the UK, obviously with everything happening there, they're not saying to pull out of the UK as an investor. They're going to keep investing. They're going to keep some positions open there just to keep a touch on the market, but not overexposed to the pound or any British assets in that matter. And I think we slowly see this rippling out everywhere. It's like it's a less of a aggressive investment approach across the board. There's more, pull back into defensive, defensive/balanced kind of portfolios where they're focusing on the stable things that have strong fundamental underlines, like commodities, like gold and silver. You also see that, emerging markets are still very interesting for them. Obviously, with COVID, they already struggle with other issues anyway. So COVID is not really a stumper that much. It just slows things down, but it doesn't change the prospect. And there's obviously the good side of COVID, and that is that there is a market shift happening that was due to happen. And I mean that in the way that we work, live, and interact. And I think that was coming anyway. As we see in the newer generation, the younger generation, we see that shift already. And as much as we also have issues with the millennials and the snowflakes, where we see the entitlement and a little bit of a distance that really is out there. It's a transition period, and I think this kind of like catapulted it in to more traditional companies also thinking in a more flexible way, allowing people to work from home, doing half-half. So I think the whole dynamic of the industry, of the world in general, is actually going to change because of the pandemic, just accelerating what was going to happen anyway. And I think that is going to eventually create new opportunities in work as well. I think we're going to see more freelancers, and we're going to see, and this is down the line, a few years down the line, we think also going to see a complete overhaul of a lot of different things, including the aviation industry. So what I mean by that is, luckily I know my wife works in the aviation. They're already basically budgeting till 2025. They don't expect anything before that to go back to plus. And this makes sense, right? They expect most of the larger companies to actually close down. There's going to be a few of the major ones that will stay. There's going to be a lot of layoffs in the airline industry. Think about cruise industry as well, right? Pleasure cruises, that's going to get hit really hard. So they're going to have to change the entire way that these things operate. So we are going to see opportunities in the markets for investments in these things, in new starting ventures and new ideas. I don't think anybody's going to do a digital cruise, but there might be like, downscaled mini cruises, something like that. Because it's better to have something than nothing, and there's still a way to cover the cost if you just make things smaller, right? So I think we're going to see more downsizing instead of upscaling like we used to. But at the end of the line, I also think it's going to mean there's going to be more monopoly positions in different markets, and that can have some negative effects, obviously, where they can abuse that position to influence market prices. But there's going to be a limit to that again, due to a lot of people being unemployed and looking at new work. So what I see a lot is people getting a freelance position where, okay, on commission sales or something like that, but no fixed pay, and it's more like a work for yourself kind of deal. I think there's going to be a lot of that. I think we're going to see more of that in different scenarios as well. More freelance, more side hustles, as they call it as well. I think people are going to start getting creative, and you also have the other side where you're going to have more people that are going to be basically giving them, throwing their hands up in the air and just giving into it. Those are going to be the ones that we're going to have to pick up the pieces from. Other than that, the vaccines, yeah, well, we'll have to see what happens with the new varieties. The risk of the stimulus is more like, okay, if the outlook of the COVID worsens and it creates a deeper scarring than expected, I think that there's going to be another push for like stimuluses in the rest of Europe, as well in the US. I think just in the US, you're going to see that they will need Republican push to get that through, which is going to be interesting to watch. So that's where the US might actually start, losing a little bit of that momentum that they have now. Brexit. Well, Brexit is done. We're in Brexit now. Widespread effects. We knew that the trading was going to be hammered first. Obviously, customs, everything like that was going to fall on its ass. We knew that from the start, right? That was going to happen. They were never going to get that round in time, especially due to the way they were bouncing around. Now the question is, what is it going to do? So yeah, the foreign policies have to change. Trade agreements need to be made. Scotland is the fishermen in Scotland are having literally boatloads of fish dying and rotting away because there's not enough market in the UK alone to take all this fish, and these people are starving now, right? Starving financially speaking, because they can't get rid of their produce. And for fish, for instance, shipping it to the US is not exactly the most ideal situation unless you start freezing them. It's better to go to Rotterdam, for instance, and just put them on the fish market, which is like a hop, skip away. But that's just one very, very small part. What I see with the asset managements that I work with is there's a very high demand still for real estate in the US and the UK. And the reason for that is I may have bought one too. The rental culture in the UK is actually increasing, and it's super stable. So there's a lot of foreign investors in the UK when it comes to real estate. Better yet, London is expected to be about 90% owned by non-nationals. In other words, 90% is owned by foreigners, and they're all renting it to the locals, which is insane. But London's always been a hotspot for investing in real estate, and I think that is going to increase, especially with the Northern Powerhouse now getting online, with Manchester up there. Yeah, there's going to be changes there as well. I think obviously if people can't pay rent because of unemployment, that's a different story. We're going to see how Brexit is going to form the UK. Back in 2016, 17, 2017, I was doing something similar like this, and I explained if there was going to be eventually a no deal Brexit, apart from the trade being the issue, I think that what we're going to see is a lot of Brits leaving the UK to go find work outside of the UK, simply because the localized economy won't be able to sustain that much of a workforce. I don't think that's changed much since then. I still think that that workforce has not really the job offerings versus the populace. I don't think that ratio changed very much. So I think that that is going to also affect the stock market in the UK. That once people start leaving the UK to try and find jobs overseas, they're going to have to try and stop that somehow. So there's probably going to be some stimulus for that, or they're going to allow it, and then the stock markets will start dropping a little bit in the UK, which means that the pound's momentum that it has right now will, as everything develops right now, we're most likely going to see a little bit of a change there as well. If we look at the UK stocks, right, for instance, I think the stocks are going to be in need of like a diversification a little bit. Um, we know the formidable problems that we have within, the UK government. Obviously, also, the corporate side is, how do you say this? The corporate side of the UK is having some bias towards, uh, services. Obviously, the export is hammered. I think from an investment point of view, the best way to prepare for basically whatever is going to happen, for instance, if they're going to be reliant more on travel down the line, that, which increases energy consumption. So what can happen there is that, you know, to keep the exposure to the UK is what the asset managers are going to do, but with a leash to the Silicon Valley side as well, right? So you get like this split where you can't just invest in the UK or just in Silicon. It's going to be like this split is going to be more tethered to have those two stable economies, or stable, strong economies, both in check, and then be able to switch depending on which one starts to do better, and diversify their portfolios because of that. On that, yeah, no, I think Brexit is going to be another pain for 2, 3 years when they start getting the first policies actually on paper and done, and then it's going to take 5 years from now before, trade starts picking up again. And then obviously with the pandemic, we don't know if how much that's going to be delayed or accelerated. Um, they're getting increasingly reliant on trade, but we can't trade right now or travel. So we'll have to see how these things pan out. Now, if we look at commodities, what does this mean in the retail trade? So the euro if we look at euro face value, in my opinion, I think the euro is stable, but is weakened by the pulling away from investors, mainly due to the uncertainty of policy making when it comes around, unfortunately, the pandemic around COVID. And obviously, we see the whole vaccine nonsense, like company are shunting the AstraZeneca one, and they're pushing it to Greece, and Greece is actually like accepting it, but the people here are not accepting it. It's like there's no leadership within Europe at the moment. Everybody's doing their own thing. Nobody wants to agree on anything, uh, and because of that, the euro is kind of left over to its fate, depending on what the other ones are doing. Um, this will obviously change if the European Union gets together and actually starts making a solid plan of how we're going to move forward and what are we going to do. I do think the euro will strengthen, and this little bit of a stagnated trend will change, and we'll start seeing a growth on the euro as face value. Now, if we compare that to the pound at the moment has the momentum still. Like I said, there's still a lot of foreign investments going into Britain. The pound has a lot of movement still. I think versus the euro, this momentum is slow but steady, and I don't expect it to not continue. I do expect it to keep pushing on for now. Um, the big hinge was on last week's rate decision. There was a rumor that it may have gone back to 0 when they just went to 0.1. Luckily, they did not do that. Because of that, I think it will just continue its momentum. I think the fundamental underlying drivers stay the way they are right now. Prices are factored in, risks are factored in by giant asset managers and hedge funds and so on. So I think if you look at Euro GBP, for instance, I don't see a change in trend. There might be a small pullback because of required need, because it can't grow steady as much as it does right now. But then, I mean, I would definitely, still look at, if we look at Euro GBP, I would favor the pound over the euro. Australia is a funny one. The AUD obviously has a strong, solid economy, Australia on its own, and they have a very unique advantage at the moment. I don't know if anybody's here from one of my previous. Does anybody remember what their unique advantage is at the moment? There's a Q&A thing that you can type in, by the way, if anybody wants to give it a guess. No, first one. Yeah, that's exactly what I'm going to. So not specifically China, it's Asia. So it's basically geological positioning. Very simple, right? They are the only ones that are in position with access to the Asian market at the moment, because the rest of us can't get it. So that's what's making the AUD so strong at the moment, which we know, obviously, with the European policies being so weak, means that the Euro AUD keeps doing what it's doing. I think basically across the board, what we've seen from the start of 2021 is that the trend from 2020 carried over. I don't think there's any major changes at the moment in the fundamental drivers. Despite all the changes, the USA is the only wild card where Biden basically only has to make one small misstep and we're done. The AUD is going to stay strong as long as this dynamic doesn't change. Once the trading routes open again, to any degree, I think the AUD will have a little bit of a backlash. So I do expect that to be a pullback, which makes sense, right? It's going to get a little bit of correction because they lose their position of power. And I think at this point, the dollar, we've roughly discussed the dollar. I think the main positivity here is that there's no more question about the stimulus package. That's going to get pushed through. I think down the line, this is going to have a backlash, but right now, not yet. It gave a little bit of confidence from an aspect of stock markets, right? Which, obviously helps the dollar be its strength. We still see it peaking. We still see it have momentum. I think all of this is eventually going to stall out by the end of Q1, and then possibly have a fairly seriously, starting pulling back and correcting. To how much of a degree, how fast is uncertain, because there's just too many factors that are up to a pandemic being resolved other than outside influences. What we do see is, fundamentals like gold. I discussed this in my webinar a month ago, where I explained that gold cannot keep pushing high. And it was actually 2 days after that it had the first dip. The reason for that is very simple, right? Gold, it might be, that safe haven investment, but it's also a commodity that is used as a raw material, jewelry, right? So eventually the price of jewelry production gets so high because the raw material gets so expensive, they stop buying it. Well, guess what happened? Asia stopped buying it, and they're the biggest taker of the gold, and that's why it dipped. It was expected to dip anyway. thinking about gold, I mean, 1800's not out of the question. 1750 probably. I would expect it to pull back to 1750, maybe stabilize there. It could go further down. It should go further down, but that again relies on a few other things. I don't expect it to go, past the 1950 mark. In case it wants to make like a run back to the top, it might just match the historical one from a month or two ago, but that'd be a long shot. I think the main thing is that we just go see a stabilization around 1800, 1750, somewhere around there. I think it's going to linger around that level for a bit. Oil. Yeah, I had a question about oil a few weeks ago. What do you expect it to do when it was at 30? I said, well, expect it to go to 60 at very least, and then 80 most likely. The main reason for that is basically where the manufacturers want the oil price at, period. And as long as it's a supply and demand that it is, and you have the ability to simply shut down a factory to reduce supply and keep the demand the same, you can manipulate the ratio or the price goes up. So I don't really have any question in my mind that we're going to see $80 a barrel, perhaps throughout this year. There will be some pullbacks, but overall, I think oil is just due to go up, and that's the same for WTI as it for Brent. Brent will be slightly underneath. Or we'll see how Brent does actually with the whole Brexit thing, but generally oil is fairly stable anyway. Silver, on a side note, the guys from GME tried silver. I don't know if any of you caught that as well. Silver and gold and stuff like that, the fundamental drivers underneath them are so strong, you can't really pull that little spiky trick. They tried, didn't work out, thankfully, because that could have really, really bad effects when that does happen. But yeah, so silver is going kind of like follow, right? It's a similar kind of commodity. So how do you use any of this information or any of this information? How do you use that in your trading? Well, basically what I mean is trade short in the long game. Right? You know the outlook in the long run, right? Euro at the moment moving sideways. Has that been moving sideways since the pandemic started? If you look at it, it's been balancing around a single line across the board. So that's what you work with, knowing that it's going to bounce up and down in there. And that means that your short terms are, generally speaking, you're going to want whatever the established trend is. Every time it gets to the bottom of the channel or the top of the channel, depending on the direction it's going, that's when your moments are to jump on it. You don't need to wait for price action. You just wait for turning points there. Down the line, when you know the fundamentals are going to start shifting, adjusting indies like Australia, what's going to happen is that you need to start paying attention then in closing any positions that you have open in certain markets, because they might flip, and then you can potentially try to get the swing trade. For those that have small accounts, don't do that. Those that have small accounts or anything under 5,000, just wait for the trend to establish itself. It's okay to wait a few weeks and then jump in. You just don't have the breadth or the funds to really trade properly on swings and bigger trades long run, right? We don't have that luxury, right? We don't have the luxury to open trades for 6 months. So you have to trade the shorter term, but you have to think like the bigger guys are. So think a quarter ahead. What are they expecting for Q1? These reports, by the way, you can find them. Global strategy reviews, I think that's it. If you do something like that, you should be able to Google a few. You'll probably get Goldman Sachs, JP Morgan, the bigger established guys. You'll get their outlook. They don't specifically say price points or anything, what they're going for. That makes sense, but it's like an overall look, kind of what I just now did as well. And this helps you understand, okay, so this is what they're thinking of doing. And they're all going to differ a little bit from each other, but they're going to have a rough same idea. So if everybody is longing the dollar, then don't short it. Don't try to fight the big guys. Right? Just play the game with them. You just trail, you just play along, and you will get more out of that than trying to fight the system, because that doesn't work. That's been proven so many times. You just stop trying. So, but understand from a fundamental point of view where the decisions are coming from, so you understand when the fundamentals change, the adjustment in the fundamental drivers, that you can accordingly react and close open trades or double up on good trades that are already running and have this factored in, right? Let's see. So for instance, let's see, I have a few charts. What is this? I actually set this up for LegacyFX. So yeah, this is the this for instance Euro AD. I put this blue line in. That's basically a weekly resistance. That's pretty much the price point I would go for, that it would eventually go to. It's going to bounce back first, and then it's going to probably hit for 152. But what I wanted to do is gold. So here, for instance, we have gold. And with gold, what I did want to really take a look at is, obviously we have this rejection. Now this is the big weekly trend. I only look at week if, especially commodities and stocks, don't do that on hours, guys. Just long run only. It's not a thing to trade on short term. It moves way too much, and you can't properly set up stop losses and risk reward ratio. You have to think long run. You have to sit down for it. What I expect this to do is basically bounce up and down between here. Now this is where, if it's going to do a breakout run, it's going to do this. It's going to go back to around this level, which is right here. No, I made my arrow too long there. So it's going to do something like this and then bounce probably. If not, I expect it to go back to 1550. That's where I would expect it to go, and it has to do with this whole story here. So I think it's going to go bounce in and then go bounce up and down in here between 17 and 15. That's what I would expect it to do. Obviously, I keep monitoring the market on a daily basis. Certain things may change. Let's take a look at Euro US dollar. So Euro AUD was actually a really funny one. I told people to sell it a few weeks ago, and if they did, they were actually hit their take profit, which was this one basically. So what happens is, I expect that the bounce off from this daily, the blue is day, by the way, blue is daily lines, and the red ones are my weekly lines. The weekly lines overrule blue lines, right? So if it's at a red line, I don't care about the blue ones. If it's nowhere near that, then the blue ones overrule, because then it's probably going to listen to that first. If it doesn't, then it's going to go for the weak one. So yeah, I color code. This is very simple. This is very basic. This is not how I trade. For those that are going to ask that, no, this is really, really stripped down. This is just for the presentation, but otherwise we have way too much on the screen. So here again, like, a little bit, okay, this is going to like sideways. If this does want to pull back, it's probably going to hit here for the double top thing and then go back down here, break this median line probably here, which will allow it to hit the bottom of the trend. Now, if it breaks that, then we're probably going to see 150, 115. I wouldn't expect it to go lower than that at the moment, though. I think 115.7 is probably the price point. Eventually, everything is going to stabilize back down here, but that's probably a year down the line. What else do we have? Euro GBP, there was also one. So Euro GBP, yeah, I mean, basically this. It's been moving sideways for literally since 2016. This blue line is a daily resistance. The median line is literally the price where it's at right now, 0.7. Yeah, it's been doing that for 3 years. I mean, I don't know why it would change. It's right now has momentum versus the euro, but overall, we also know that in the long run, if it keeps the momentum, if European rulings don't change, yeah, then probably by this point, which is the end of May, so about 4 months down, which is halfway through Q2. Yeah, I expect it to be at 82, the low point, and then probably bounce up just by pure price point rulings. But I do expect it basically bounce off of this back up, get like that recession point, and then I would look for, so when it gets back to the top here, I would look for a sell moment and just sit down and just enjoy the ride. I wouldn't bet against it that much. I wouldn't bet. If you have a small account, I wouldn't trade the uptrend because your resistance is here. So it's like you'd have to go in now, and now you're guessing against the trend basically. Just wait for the price action and then go in if you're going to trade against it. Otherwise, just wait for it to hit the top somewhere here and then take the sell instead. That's the more safe bet. Euro AD, did I do anything on that? Oh no, that was the one with 52. Yeah. No, that's it.